Welcome to SpeedyPodz, episode 15.
Let's get right into it.
We're doing our rapid-fire look at this week's big stories in finance, AI, and policy, really focusing on what you need to know fast.
And we're starting with a huge headline.
The headliner? Absolutely. Michael Burry, yes, the big short guy, is making a major bet against the AI boom and specifically against Palantir.
And this is where it gets interesting immediately, because the initial reporting was just wildly off.
The numbers were just not even in the same ballpark.
Right. CNBC reported a $900 million short.
$900 million.
And then Burry himself had to come out and clarify, no, it's actually $9 million. It's a, two order of magnitude error.
A classic case of misreading the filings. But the real story isn't the dollar amount, it's the reason for the short.
Exactly. His core accusation is that hyperscalers, we're talking about Meta, Oracle, the big players with huge data centers, are, in his words, cooking the books.
And he's pointing directly at their accounting for all that expensive new hardware.
Yep, the depreciation. They're extending the useful life of these super expensive NVIDIA H100 chips from, say, 3 years out to 6 years, or maybe even more.
And for anyone listening, that might sound like a minor accounting tweak, but the impact on the bottom line is enormous.
Oh, it's huge. I mean, you're basically spreading the cost over twice the time. So your reported annual operating cost gets cut in half. It's a direct boost to earnings.
So for a giant like Google, sources say this could swing their operating profit by something like 10%.
It's a massive lever to pull. But there's a counter-argument.
Which is that maybe the hardware just actually lasts that long now.
Well, that's the whole debate. The defense from the companies is pretty strong. Google's head of AI and infrastructure pointed out that their custom TPUs, their own chips from 7, even 8 years ago, are still running at 100% utilization.
So they're arguing it's not financial engineering, it's just reflecting reality. The demand is so high that even old hardware is still fully in use.
If that's true, then the longer depreciation schedule is completely justified.
Okay, so let's shift to the company Burry is actually targeting with the short, Palantir. The valuation there is just extraordinary.
It's a total outlier. You've got a market cap around $480 billion, and it's trading at, 137 times sales?
137. I mean, you look at their peers like Datadog or Snowflake, and they're down around 13x sales.
It's a completely different category.
Yeah.
But the defense of that premium is fascinating.
The bulls say it's a unique company, right?
Yeah.
There's no real alternative.
Exactly. The software is so deeply woven into government and defense ecosystems. These are very sticky, long-term contracts. So the churn risk is almost zero.
So investors see it less like a tech company and more like a guaranteed annuity. The cash flows are seen as incredibly durable.
That's the entire bull case in a nutshell.
Okay, but zooming out, this whole boom in the Magnificent Seven is basically driving U.S. GDP growth. And it's all bottlenecked by two things: power and talent.
And that talent piece leads us right to the policy side of this, the whole debate around the H-1B visa program.
Yeah, the system seems pretty broken. You hear about these huge companies just flooding the lottery with hundreds of thousands of applications for their employees abroad.
They completely swamps the system.
Yeah.
And so one of the proposed fixes is to introduce a price signal.
A big one. Something like a $100,000 fee per visa, or maybe even an auction.
The thinking is that this would guarantee the visas only go to the most highly specialized, irreplaceable talent. And you could use that money to fund vocational training here in the U.S.
Right. Turn a cost center into a profit center for the country. It sounds good. But what's the counterpoint?
The counterpoint is that a huge fee just helps the big guys, the hyperscalers who can afford it. They can freeze out smaller, innovative startups that desperately need one or two key people but can't compete at that price.
So it's not a simple fix. Okay, let's tie this all together for you.
Right. We have this core tension. Is this all just financial engineering and hype, like Burry says?
Or is the demand real, the hardware really that durable, and are these extreme valuations actually justified by these incredible moats?
That's the question. Is this sustainable growth or the peak of euphoria?
And we want to leave you with one final thought to mull over.
Think about SoftBank. They recently sold all of their remaining NVIDIA shares.
All of them. Wow. So the hardware layer.
The hardware layer, the chips.
Mm-hmm.
And they took that cash, a reported $30 billion, and invested it all directly into OpenAI.
Into the model, the intelligence layer.
Exactly. So you have to ask yourself, is the smart money signaling a major pivot? Are they telling us that the real long-term value isn't in the picks and shovels, but in the intelligence itself?